Welcome to the Deep Dive. Today we're cutting through the complexity of a topic that often feels, well, pretty overwhelming for families. We're talking about inheritance tax, or IHT. Especially now, with asset values rising, it's pulling more and more estates into the taxable bracket. Our sources today really focus on the foundational planning strategies. They make it clear IHT isn't just for the super rich anymore. It applies to your estate's value when you pass away, but also, and this is crucial, to certain gifts you might make during your lifetime. And if you don't plan, well, that standard 40% rate kicks in above the thresholds.
That's exactly right. And for you listening, the goal today isn't just, defining terms. It's about understanding the actual levers you can pull. We're isolating the absolute foundations of IHT planning, the core tax-free bands and the most straightforward lifetime exemptions. Knowing these rules, it's really essential for protecting wealth and, well, passing it on efficiently. So, okay, let's unpack the bedrock here, starting with the Nil Rate Band.
The Nil Rate Band, yeah. RB. When people mention IHT, this is usually the first figure they need to get their head around. It's the core allowance, isn't it? The amount an individual can leave behind without any inheritance tax being due.
Yeah.
Currently, that's £325,000. It's the main threshold applied to the estate at death, after, liabilities and certain reliefs are deducted.
Mm-hmm. But what's really fascinating here isn't just the amount itself, it's the transferability. This is where the planning power really lies. If someone's married or in a civil partnership and they pass away without using their full £325,000 NRB, well, that unused percentage can be transferred over to the surviving partner.
Ah, okay. That sounds like a huge safety net. Because often, I suppose, if everything just passes to the spouse on the first death, that NRD isn't used at all, is it?
Precisely. It often goes completely unused in that scenario.
Well, what are the catches? Does the survivor need to do something specific, legally, to claim that unused bit? Or does it just happen automatically?
No, definitely not automatic. The survivor, or usually the executors dealing with their estate later on, they have to actively claim it. And there's a time frame, too. So it underlines why good record keeping and clear paperwork are just so vital.
Right.
But the benefit, it's immense. It essentially allows that couple to potentially double their collective tax-free allowance, up to £650,000 when the second partner eventually dies. That transferability, it's really the key bit of flexibility. It sort of underpins the whole estate structure for couples.
Okay, so £325,000 NRB, potentially double to £650,000.
Yeah.
Got it. Now let's talk about the second major tax-free band. This one's specifically tied to property. The Residence Nil Rate Band, or RNRB. This is an extra allowance, isn't it? It sits on top of the standard NRB.
Yes, exactly. And if you look at the bigger picture, the RNRB was brought in really to help families pass on the main family home without facing quite so much tax. The allowance currently stands at £175,000. So add that to a potentially doubled NRB, and you can see how a couple might, in theory, pass on up to £1 million tax-free.
£1 million tax-free. That's obviously a very powerful incentive. But the RNRB has a reputation for being tricky, doesn't it? You mentioned it's for the main residence. And crucially, it has to be left to direct descendants, children, grandchildren, that sort of thing. What are the main tripwires here?
Yeah, there are definitely conditions. The big one, the major pitfall, is the tapering mechanism. While the £175,000 RNRB sounds great, it starts to shrink if the net value of the deceased estate goes over £2 million. That's the threshold.
It shrinks. How does that work?
For every £2 the estate is valued over that $2 million mark, the RNRB allowance itself gets reduced by £1. So what this means is, if you have a higher value estate, currently anything over £2.35 million, you might actually lose the entire RNRB allowance, even if you leave the house directly to your kids.
Wow. Okay, so it vanishes completely at that point.
It can, yes, and this is vital for you, the listener, to grasp. The value of your property and the value of your total estate interact differently with this rule. You can't just assume you'll get the RNRB if your overall assets push you past that taper threshold. And, just like the NRB, the RNRB can also be transferred between spouses or civil partners, assuming all the other conditions are met when the second partner dies.
Okay, that's complex but crucial. So those two bands, NRB and RNRB, deal mostly with the estate after someone passes away. But effective IHT planning really needs to start earlier, doesn't it? During a person's lifetime. Let's maybe pivot now from those big allowances at death to the simpler, more accessible things people can do right now. Tools to start reducing their potential estate value efficiently.
Exactly. These are the most straightforward ways to begin chipping away at your estate without needing complex legal structures, like trusts immediately. The annual exemption is probably the cornerstone here. It allows an individual to gift up to £3,000 each tax year. And those gifts just fall completely outside of IHT calculations. They're instantly exempt.
It's a use it or lose it kind of thing, mostly. I think I read you can carry it forward, but only for 1 year.
That's right. If you don't use your £3,000 allowance in one tax year, you can carry the unused part forward to the next tax year, but only for 1 year. Then it's lost. So the key strategic insight here is really the power of consistent action. Using that £3,000 limit regularly, year after year, you can systematically reduce your estate value. These are immediate, fully tax-free transfers. Easiest method there is, requires no special paperwork, no 7-year survival period.
Simple and effective.
Yeah.
And alongside that, there are even smaller exemptions, aren't there?
Yes, the small gifts exemption. This one's quite handy. You can gift up to £250 to as many different people as you like in a single tax year. The main condition is that you haven't used another exemption, like the annual £3,000, on that same person in that year. It's perfect for things like birthday presents, Christmas gifts, that sort of thing. And then, don't forget, there are specific reliefs for wedding or civil partnership gifts. The limits depend on who's giving the gift. A parent can give up to £5,000 tax-free for a wedding, a grandparent up to £2,500. People often overlook these, but they're simple, legitimate ways to reduce the estate's footprint right away.
Right. Okay, so those are the immediate, straightforward gifts. Now let's move slightly beyond those annual allowances and look at the foundational concepts for longer-term gifting strategies, where that famous 7-year clock starts ticking.
Right.
We're talking about potentially exempt transfers, PETs.
Yes, PETs. A PT is essentially any significant gift made directly to another individual during your lifetime. Not into a trust, typically, but person to person. It's called potentially exempt because, well, its status depends on time. If the person making the gift, the donor, survives for 7 years after making it, the gift becomes fully exempt from IHT. It's treated as if it never happened for tax purposes. That 7-year survival period is absolutely key.
But what if? What if someone doesn't make the full 7 years? It's not like the tax suddenly slams back in at 40% on day 1 after year 6, is it? You mentioned taper relief earlier in a different context. Does that apply here too?
It does, thankfully. It significantly softens the blow if the donor doesn't survive the full 7 years. If the donor passes away between 3 and 7 years after making the PT, the amount of IHT charged on that gift gets reduced. So, for example, if death occurs 3 to 4 years after the gift, the IHT due is reduced by 20%. If it's 5 to 6 years, the reduction is 60%.
I see.
This tapering mechanism means making the gift is still usually highly advantageous compared to just keeping the asset until death, even if the full 7 years aren't quite reached. The potential tax is reduced progressively.
Okay, that makes sense. And PTs are often contrasted with another type of lifetime transfer, the Chargeable Lifetime Transfer, or CLT. When does a CLT typically come into play, and why is the tax treatment different from the start?
Right. CLTs are different. They mainly apply to gifts made in certain types of trusts, particularly discretionary trusts. The reason they're chargeable from the outset is that they might trigger an IHT charge immediately, right when the transfer into the trust is made. This happens if the value of the gift pushes the donor over their available Nil Rate Band at that time.
So the key difference is immediate potential tax versus tax only if you die within 7 years.
That's the crucial distinction, yes. PETs only become potentially chargeable retrospectively if death occurs within 7 years. CLTs can be chargeable straight away, at 20% usually if tax is due. Recognizing that different signals you're likely dealing with a more complex trust structure, and professional advice becomes absolutely essential.
Okay, so we've covered the bands, the simple gifts, the PETs and CLTs. Let's talk now about some of the strategic heavy hitters, the tools that can really dramatically change the IHT calculation, often going way beyond just simple cash gifts. We often hear about business relief, BR, as being a potential game changer. How does holding certain business assets work to, well, essentially wipe out the IHT liability on that part of someone's wealth?
Yeah, this is where planning can get seriously powerful. Business relief, and its cousin, agricultural relief or AR for farming assets, can provide either 50% or quite often 100% relief from IHT on the value of qualifying assets. For instance, you typically get 100% relief on shares in an unlisted trading company or on an interest in an unincorporated trading business like a partnership. The main condition usually is that you've owned the asset for at least 2 years.
So 100% relief means it's just completely removed from the IHT calculation.
Completely removed. That's the strategic insight. Holding assets that qualify for 100% BR effectively takes their value right out of your taxable estate. This is often a major driver behind decisions to, say, hold on to a family business or even restructure investment portfolios towards assets that qualify for BR because the tax saving is potentially enormous. You could be avoiding a 40% charge on millions of pounds worth of assets.
That is significant.
Yeah.
And finally, let's touch on pensions and life insurance. They often seem a bit separate in IHT discussions, but how do they fit into the planning picture?
They're incredibly important, often overlooked pieces. Pensions, particularly defined contribution pensions, are typically treated as being outside the estate for IHT purposes. This relies on the funds being handled correctly on death, usually through a nomination form naming beneficiaries or sometimes via a spousal bypass trust. But the result is that pension pot can often pass on tax-free from an IHT perspective.
So the strategy might be to use other assets first.
Exactly. Many financial advisors suggest that if clients have other investments or savings, they should draw income from those taxable assets first, trying to preserve the pension fund. It effectively shields that wealth from IHT for as long as possible, maybe indefinitely.
And what about life insurance? How does that play a strategic role?
Life insurance comes in particularly handy for managing the eventual tax bill itself. The clever move is to have the life insurance policy written in trust. By placing it in trust, the payout when the person dies doesn't actually form part of their taxable estate. It doesn't inflate the problem.
So the money goes somewhere else.
Right. The cash payout goes directly to the beneficiaries named in the trust, or perhaps to the executors specifically to pay the tax. This creates liquidity. That money can then be used to settle the IHT liability due on the other assets in the estate like the house or investments. It means the family might not have to rush to sell those larger assets, potentially at a bad time, just to find the cash for the tax man. It helps preserve the core assets.
Okay, that's a really practical application. So let's try and bring this all back together for you, the listener. We've established those crucial foundation thresholds, the £325,000 nil rate band, the £175,000 residence nil rate band, and importantly, the power of transferring the unused parts between spouses or civil partners. And we also covered the simple, immediate planning steps anyone can take today using things like the £3,000 annual exemption and those small gifts rules.
So what does this all really mean in practice? Well, it means that advisors need to integrate all these elements, the basic bands, the transfer rules, the lifetime gifting rules like PTs and their 7-year clock, right through to the impact of things like business relief and pensions. Pulling it all together allows for clear, actionable guidance. It moves the conversation beyond just defining tax rules towards actively shaping strategies to protect family wealth across generations. But this raises a really important final question for you to consider, because IHT planning, it's never purely about minimizing tax, is it? There's always this difficult trade-off. A balance between 3 key things, really. 1 is the desire to reduce that final IHT bill as much as possible. 2 is the absolute need to make sure you keep enough wealth back for your own financial security, for your own future needs, whatever they might be. And 3 is often about control, the desire to maintain control of your assets for as long as you possibly can, maybe right up until the end of your life. So the question to ponder is, when you think about your own situation, which of those 3 factors, minimizing tax, ensuring your own security, or maintaining control, stands out to you as the highest priority? What really drives your thinking when structuring your future plans?